A much anticipated week around earnings and an impending Fed announcement that began with a lot of fear, ends with mostly FOMO. So heading into this week, markets were very nervous. It had a decent little rally here in the last week or so, but a lot of big earnings announcements coming this week. Of course, the Fed was going to hold its press conference. The fact that it was going to raise by 25 basis points was a foregone conclusion, but what was going to come next? Down 1% to start the week on Monday, down 1% here on Friday as we shoot this, but in the middle, a big rip within market. So what was it? As far as earnings, Apple will make big news. The fact that they kept mentioning market uncertainty was unnerving to a lot of people. Google had some less than better expectations, but on the whole, including a lot of companies that aren't household names, earnings are holding in there. And so you'll hear a lot of bears saying, yeah, it's still going to fall apart, and it may. But as of right now, the market, the economy continues to be very resilient. The labor market continues to be really resilient. And so, at least as the market's concerned, we're in this so-called Goldilocks phase for the moment, where things are cooling down enough to give hope that the Fed's rate hiking cycle might be ending soon. And at the same time, it's not so bad that we're worried about that so-called hard landing / economic collapse. As far as the Fed announcement, if you want some more details, including some great summaries from some analysts that we follow, check out the written part of the commentary. But in short, they didn't say a whole lot. But the fact that they were wishy-washy and not too clear, the market interpreted as being dovish, i.e. they are getting close to the end of their hikes. A little bit odd in the sense that if you really look at Powell's comments, he mentions a lot of time, I'd rather hike too much than too little. Most of the Fed governors, voting governors who've spoke up on this issue have suggested they're going to raise not just 2 times this year, but 3 times. But for now, the market's calling their bluff and thinking that this is, again, just jawboning to try to quell the animal spirits. It didn't work this week. And as a result, from Tuesday to Thursday, you had 3 consecutive days, both in the S&P 500 and in the NASDAQ, where the market ripped 1% higher. That's only happened 8 times since 2001, and only in 2001 did it not result in a market that was notably higher 1 year later. So something to keep in mind. Quantitative signals in history. So if you flip to page 2 of whatever financial journal you might be reading, there'll be some real geeky stuff around yield curves. We've touched on that in the past. Wherever you look, the 10-year Treasury versus the 2, or what we like to look at, the Fed likes to look at, the 10-year versus the 3-month T-bill, the yield curve is solidly inverted. And classically, this means a recession is imminent or underway. We still are the camp that we had a recession last year, that's what this yield curve signal is about, as we've told you before as well, with how much the Fed's been intervening, all the different things that took place during the COVID pandemic. We think trying to extrapolate too much from the yield curves is a mistake because, again, there's just so many more new variables than has ever been the case prior. Also important, as analysts at Alpine Macro pointed out this week, if you look at the TED spread, a traditional risk indicator, if you look at high yield spreads, how much people are charging for less quality bonds over high quality bonds, pretty narrow. There's a lot of things that still would suggest that a recession is not imminent or not being priced in. In any case, the thing we want you to take away is these kinds of things certainly need to help frame the realm of possibilities for you, but they can't be guiding your investment decisions. And even more importantly, they're not indicators of exactly not only what the market may do, but again, the magnitude of what that market may look like. A lot of people suggest, if the inversion's even steeper, that somehow means the market drawdown could be steeper. There's no correlation there. Makes for great fodder, easy implications, but it is not accurate. Looking at history, much like we touched on earlier, as January goes, so often goes the rest of the year. So I know this is Groundhog's Day, too busy to know what that groundhog decided. But if you look at January as kind of a metaphor, proxy for the market, VIT pops its head up and is solidly positive. The rest of the year usually goes pretty well, on average over a 10% rate of return. And so again, that looks pretty good as we set up, particularly if a 5% plus move comes after a bear market or a down 10% prior year. It's only happened twice, 1967 and 1975. And in both cases, the market was up solidly the next year, 11 and 17% respectively. Again, just like those yield curves, can't use these things to predict, but it does help shape the realm of what is most probable. Lastly, and most importantly, focusing on what you can control. I'll see clients wring their hands over whether they should be a growth investor or a balanced investor. Should they allocate to this, that? What is the yield curve going to mean? You know what you need to do? You need to make sure you're maximizing the dollars that you do have. And one of the easier things to do right now is to take a look at that excess cash. I know, particularly after bear markets, it's very natural for people to say, I need an extra large, warm, cozy safety blanket of cash. And I'll hear people say, I'm ready in case something unexpected happens. Don't know too many life events of all the different lives we're leading by extension where I've seen $500,000, $250,000, $1 million unexpected events arise. And yet with some regularity, we're finding clients and companies with six-figure plus allocations to cash. First Trust refers to this as losing money safely. And so much like that frog in boiling water, inflation is eroding your net worth all the time, and these days pretty quickly. And so while that balance sheet might look flat, what you're most afraid of, which is losing the power to go buy things, is actually occurring all the time. If you look post-2008, if you're holding cash relative to inflation, you are losing just under 2% a year. Over 15 years, it's a huge erosion in your purchasing power. Even if you take into account 2008, where cash was one of the top performers because of the bear market, and ended it in 2022, cash is by far the worst performing asset class on a total annual return, only 0.4%, which again, after inflation, is solidly negative. In summary, don't let the headlines and the market moves stir not only your emotions, but your portfolio allocations. Take that time, understand what the market's most likely to do next is a thing that's going to most surprise us all. And so again, where we need to spend our time and focus is in controlling the controllables. That's staying disciplined, working on that plan, and right now, taking advantage of the things that exist after 2022 to get that hard-earned cash that you've saved to work, helping you propel you and your family towards your goals. Thanks so much.